Welcome to Talk Tickers. We dive into the latest earnings calls, cutting through the noise to give you the real insights. Today, we're looking closely at Urban Edge Properties. They're a retail REIT, and their second quarter 2025 results just dropped. And what it looks like they're not just navigating the current retail scene, they're actually thriving. Get ready for a look at some strategic moves, impressive numbers, and maybe even the revenge of the nerds in real estate.
It is a fascinating story, really. Urban Edge had a truly standout quarter. They showcased not just strong financials, but also, an operational agility that really drove a significant, very positive market reaction. There's quite a bit to unpack, I think. We'll find some pretty compelling reasons why they seem so well positioned right now.
Absolutely. So let's dive right in. Give us a feel for the headline numbers.
Yeah.
What did Urban Edge actually deliver this quarter?
Yeah, they absolutely crushed it. So their GAAP EPS, that's earnings per share under generally accepted accounting principles, came in at $0.46. That's a huge beat. The consensus was hovering around maybe $0.09.
Okay.
But, for REITs like Urban Edge, FFO funds from operations is often the better metric. It strips out things like depreciation, non-cash stuff, and their non-GAAP FFO as adjusted per share. It hit a new company record, $0.36.
A record.
Yep. That surpassed expectations by about $0.02, which is roughly a 6% beat. It's a clear signal of really strong operational health. Now, revenue was $114.08 million. It did slightly miss consensus, maybe by 1.6%, but importantly, it still represented a healthy 7.1% year-over-year increase. They're still seeing that consistent top-line growth.
Okay, those are undeniably strong financial figures right off the bat. But financials, they're only part of the picture, right? How did they perform operationally? That's so critical for a REIT.
Right. And operationally, they were, equally robust, maybe even more impressive. Same property net operating income, that's your apples-to-apples comparison for properties they've owned a while, grew by a healthy 5.7%.
Okay.
And it climbed even higher, 7.4%, when you factor in the redevelopment efforts. But perhaps the most telling number, shop occupancy. It reached a record high, 92.5%.
92.5, that's huge for shop space.
It really is. That's a significant climb, 270 basis points year over year. That's 2.7 percentage points for anyone keeping score, and another 10 basis points just from the prior quarter. So that consistent upward trend, especially for their smaller retail spaces, it really underscores the demand for their locations and, how successful their leasing strategy has been. This strong performance, particularly FFO and occupancy, clearly caught the market's attention, signals real strength.
Yeah, it's not just the numbers, it's that underlying momentum. That shop occupancy figure really jumps out. Let's dig into what's driving that, specifically their leasing strategy. How are they hitting these high occupancy numbers and growth?
Well, it really comes down to robust and I'd say very strategic leasing activity. In the quarter, Urban Edge executed 42 deals. That covered a substantial 394,000 square feet.
42 deals, okay.
Yeah, and this included 27 renewals, which is always great to see. But what's really remarkable, the rent spread on those renewals was 12%.
12% higher rent on renewals.
Exactly. That spread means they're not just keeping tenants, they're significantly boosting the rents on those existing spaces. That speaks volumes about property value, right? And on top of that, 15 new leases.
Yeah.
88,000 square feet, and the spread there, even higher, 19%.
18%. Wow, that's serious pricing power.
It really is. And they're adding strong, recognizable tenants, too. Think Boot Barn, Fidelity Investments, just solid, Wonder, good names. What's really insightful here, I think, is how they're positioning themselves. Over 95% of their signed not open pipeline, that's S&O, is now national and regional tenants.
Okay, so focusing on bigger, more stable tenants for the future pipeline.
Precisely. This isn't just about filling space anymore. It's about, future-proofing that cash flow, building a stronger credit platform for future NOI growth. It attracts a higher quality tenant, ensures more stable long-term revenue.
That focus on quality and pricing power seems critical. It really separates them. But beyond just leasing space, Urban Edge has been very deliberate with this whole portfolio, haven't they? How's their capital recycling strategy contributing? Because it's not just filling empty stores, it's actively shaping the portfolio itself.
You hit on a really crucial point there. Their strategic capital recycling program, it has truly supercharged the company, as they put it. It's allowed them to really upgrade their asset base. Since October 2023, they've been incredibly active. They've acquired $552 million of high-quality shopping centers, and they did it at an attractive 7.2% cap rate.
Okay, 7.2% cap rate on acquisitions. Explain cap rate quickly for us.
Sure. A cap rate or capitalization rate is basically a measure of the expected return on a real estate investment. Think net operating income divided by the property's value. So a higher cap rate on an acquisition, like 7.2%, generally means they're buying properties generating more income relative to what they paid.
Got it. Buying higher yielding assets and selling.
Right. Simultaneously, they've divested $493 million of what they call non-core, lower growth assets, and they sold those at a lower 5.2% cap rate. Year to date specifically, they've sold $66 million worth, like Kennedy Commons and McDade Commons, at a blended cap rate of 4.9%.
So selling low, buying high in terms of yield. That's smart arbitrage.
Exactly. This proactive management isn't just shuffling deck chairs, it's a deliberate strategy. Sell the lower yielding, less strategic properties, reinvest that cash into higher yielding, higher growth assets. It continuously enhances their overall portfolio quality and, critically, their long-term growth prospects.
That's a clear strategic advantage, turning capital into, well, higher quality income streams. So what does all this activity mean for their balance sheet and maybe more importantly, their future outlook? How resilient are they, and what's the path forward look like?
Their balance sheet looks incredibly resilient. That's especially important in today's, economic climate. And they're not just sitting on it, they're actively managing their debt. For instance, they proactively paid off a $50 million mortgage. It was costing them 6.4% interest. Ouch.
Yeah, and they used their existing line of credit to do it, which was at a lower rate, 5.4%. So that smart move immediately boosts liquidity and cuts their cost of capital.
Makes sense.
They boast about $800 million in total liquidity now, including $118 million just in cash. And here's a really key point. Only 9% of their total debt matures through 2026.
Only 9%, so not much near-term refinancing risk.
Very little. That limited near-term debt exposure gives them tremendous financial flexibility, room to pursue future growth without being pressured by, looming maturities.
So if I'm tracking this, it's not just having liquidity, but actively managing debt, cutting costs, extending maturities, basically setting themselves up for stability for quite a while.
That's exactly right.
That's a fantastic position to be in. What about their forward-looking guidance then? Are they feeling confident? They certainly seem to be. This proactive approach builds that strong foundation, and management clearly shares that confidence. They provided updated and raised full-year 2025 guidance. FFO, as adjusted, is now projected $1.40 to $1.44 per share. That's up from $1.37 to $1.42 previously.
Okay, that's fine.
And they also anticipate strong same-property NOI growth, including redevelopment, between 4.25% and 5.0%. Now, part of this confidence is fueled by something interesting, a projected substantial decrease in future capital expenditures, basically less money needed for upkeep and improvements going forward.
Less spending needed. Why is that?
Well, maintenance capex, for instance, is expected to fall pretty dramatically. It was $36 million back in 2022. This year, they're forecasting $20 to $22 million, and eventually they see it settling around $15 million.
Wow, that's a big drop.
It's a powerful signal, right? It means they've done the heavy lifting. The portfolio is stabilized, it's healthier. It's like, you upgraded your car engine, now you need fewer trips to the mechanic. We rarely see such a clear path to lower future spending like this.
That's a great analogy. So the previous investments are really paying off now by reducing future costs, boosting free cash flow. That's compelling.
Exactly. And it's thanks to that portfolio being nearly 97% leased overall, the healthier retail market, and completing major redevelopments across, I think, 70% of their portfolio by 2027. They're also managing G&A expenses efficiently. They lowered their recurring G&A forecast for 2025 by $500,000 to a midpoint of $35 million.
Okay, so it sounds like they're really well positioned to handle unexpected bumps too. Even things like tenant bankruptcies, which can be a real headache for landlords.
Indeed. And while they've certainly seen the high-profile bankruptcies, Big Lots, Party City, At Home, those names come up across the industry. Management seems to view these less as setbacks, more as, opportunities.
Opportunities. How so?
They're strategically re-tenanting those spaces, bringing in higher credit, better concept operators. And this tends to have a positive ripple effect, right? Better foot traffic, maybe stronger co-tenancy clauses activated, increases the value of the whole center. Regarding Kohl's, a name on many investors' watch lists, Urban Edge doesn't see any imminent decision impacting them in 2025 or 2026. They actually note that Kohl's stores in their key Northeast markets are generally pretty strong performers.
So less risk there than some might think.
Seems so. In fact, they said we're actually playing offense. They're talking about potentially reclaiming spaces from Kohl's where they have the right to, under the lease term, to bring in even stronger tenants or redevelop. It really speaks to their pricing power and the strategic control they have over their portfolio now.
That's genuinely proactive.
Yeah.
Turning potential weaknesses into strengths. So given this whole picture of financial strength, operational momentum, proactive management, how did the market react, especially with that slight revenue miss you mentioned earlier? Was there any hesitation?
Not really, no. The market reacted very positively. Shares rallied over 6% on the day of the earnings call.
6%, okay.
Yeah. So that clearly suggests investors prioritize that big FFO beat, the raised guidance for the year, and just the overall strength in cash flow and execution. They looked past the modest revenue miss. It really underscores a market sentiment that values, robust operating fundamentals and clear future growth visibility, especially from a company executing this well.
And if we zoom out a bit, you mentioned something intriguing right at the start, this revenge of the nerds idea for retail real estate. What does that mean for the broader market? And how is Urban Edge uniquely positioned to capitalize, especially with that concentration in the DC to Boston corridor?
It's a fantastic phrase, isn't it? And it really captures the current mood. For years, retail real estate was seen as, nerdy, out of favor, especially compared to, say, booming industrial or residential sectors. But now it seems to be having its revenge. The investment sales market for retail assets is actually thriving.
Really? Why now?
It seems driven by what investors are increasingly seeing as durable cash flows, real growth potential, and maybe ironically increased debt availability for these types of properties again. Lenders are back. What makes Urban Edge a prime beneficiary of this revenge is their laser focus. Their portfolio is concentrated in that supply-constrained, densely populated DC-Boston corridor.
Right. High barrier to entry markets.
Exactly. Less new competition, higher demand for the prime locations that already exist. Combine that with their record occupancy. They have significant pricing power. And this isn't just about asking for higher base rents. It's about getting better lease terms overall. We're seeing more favorable rent increases built into contracts, and tenants are increasingly taking spaces as is. That significantly cuts down the landlord's capital spending, makes the deals more profitable right away. It really highlights the value of their specific high-quality locations.
The concentration plus pricing power, yeah, that's a potent combination. How does Urban Edge stack up against its peers then in this revitalized retail landscape? Are they really ahead of the curve?
Well, they are definitely punching above their weight, you could say. Urban Edge Properties has notably outperformed the broader real estate ETF XLRE, at least in the near term. We saw returns like plus 7.6% over 1 month for UE compared to maybe plus 0.7% for XLRE.
Okay, significant outperformance.
Yeah. And this isn't just a blip. It's backed by that strong signed not open pipeline, that guaranteed future revenue coming online, plus their ongoing high return redevelopment efforts finishing up. This supports a narrative that's clearly shifting. It's moved past being a leasing turnaround story, which was their focus a couple years ago. Now it's a story of durable net operating income compounding into 2026 and beyond. That's the key phrase. Management genuinely seems to believe the stock, even after the recent run, at its current implied cap rate compared to its expected NOI growth, is still relatively inexpensive.
So they see more room to run, even now.
That's the suggestion. Significant potential upside as the market maybe fully appreciates this transformation and their sustained growth path.
That's a fascinating look at a company really hitting its stride.
Okay, now for our favorite segment. Time to pitch a provocative yet plausible trade idea. And just to be crystal clear, this is absolutely not financial advice. It's a thought experiment from a seasoned analyst designed purely to get you thinking, what have you got for us?
All right. My pitch today is a long Urban Edge Properties, ticker UE, combined with a tactical pair trade, shorting the broader real estate ETF, ticker XLRE.
Okay, long UE, short XLRE. What's the core thesis?
The thesis is this. Despite its recent upward move, Urban Edge Properties still appears fundamentally undervalued, specifically relative to its unique growth trajectory and its operational resilience. Management themselves highlighted an implied cap rate for their stock still in the low to mid-sevens range, yet they're projecting at least 4% OI growth for the next several years.
Right, fueled by that S&O pipeline and redevelopment coming online. Exactly, that $24 million S&O pipeline, those high-return redevelopments, finally contributing fully. There's a disconnect there, right? Where the market maybe isn't fully valuing that future growth against their current implied earnings yield. That disconnect, I think, presents a compelling entry point, even now.
So you're essentially saying the market's underestimating their ability to keep growing income, especially now that the heavy redevelopment spending is winding down.
Precisely. Think about their differentiated strategy, that active capital recycling into higher quality open-air retail. Crucially, in supply-constrained core markets like the DC-Boston corridor. Add to that the declining capital expenditures, which boosts free cash flow, and that formidable pricing power they have from near-record occupancy. It creates a pretty strong moat against broader sector headwinds. And that revenge of the nerds narrative for retail real estate, it's not just a catchy phrase. It suggests a potential multi-year tailwind for well-managed, high-quality retail assets like theirs.
Okay, so how does shorting XLRE fit in?
Right. By pairing the long position in Urban Edge with a short position in the much more diversified and often more interest rate sensitive XLRE ETF, you aim to isolate Urban Edge's specific strengths. You're essentially betting on their superior fundamental execution and the market continuing to re-rate their high-quality, cash-generating assets upward. It expresses confidence specifically in Urban Edge's durable NOI compounding story, while hedging against potential volatility or weakness in the broader, more generic real estate sector represented by XLRE. It's definitely an aggressive play focused on fundamental outperformance within what's really a re-emerging and maybe still often misunderstood sector.
That is a truly thought-provoking angle to consider, and definitely a lot to mull over from today's deep dive into Urban Edge properties. It's a clear case study, isn't it? How strategic execution can really change a company's narrative, especially in a sector many had written off.
Indeed. Their Q2 results really showed a company firing on all cylinders. They've successfully shifted that narrative from just a turnaround to one of consistent compounding NOI growth, looking out well into the future. What's really impressive, I think, is how they've systematically de-risked the portfolio while at the same time enhancing its quality and its income potential.
Absolutely. Well, a big thank you for guiding us through all the intricate details of Urban Edge's latest earnings call and offering such valuable insights. And to you, our listener, we hope this gave you plenty to think about. We invite you to continue the conversation and explore these ideas further. As always, please remember, everything discussed here on Talk Tickers is for informational purposes only. It should definitely not be considered financial advice. Always do your own research, consult with your professional advisors, and make informed decisions that are truly right for your own situation. We'll be back soon with another deep dive.